Welcome to Business Talk, a global podcast series where we bring you closer to some of the world's most distinguished scholars and their impactful ideas. I'm Deepak, your host from India. There's a curious question sitting at the crossroads of finance and invention. Can the way a company manages its money risk actually shape whether it invents the future? Today we sit down with someone who has spent her career chasing this exact question, Dr. Sapnoti Eswar. Picture a young engineer graduating from IIT Delhi, stepping into a fast-paced world of mergers and acquisition at Standard Chartered Bank in India. That was the first chapter of Professor Sapnoti Eswar's story. From there, the path bent towards ideas, a postgraduate degree at Indian Institute of Management, Calcutta, a PhD in finance from London Business School, and eventually professorships at the University of Cincinnati and a visiting stint at Indiana University, Bloomington. Since 2021, she has called the University of St. Andrews Business School home, where she now serves as a senior lecturer in finance. She didn't stop there. In more recent work published in Research Policy, Dr. Eswar and Dr. Dimitrova turned to an unexpected corner of corporate finance, currency hedging, and found that firms hedging their foreign exchange exposure go on to produce around 12% more patents than those that don't. Her argument is bold. Hedging isn't just a defensive shield for earnings. It's an innovation decision in disguise. Her curiosity doesn't stop at finance either. She has ventured into mergers and acquisitions, corporate governance, and even the psychology of citation bias in academic research, weaving together finance, economics, and management thinking. Professor Ishwar's insights don't stay locked in journals. When the UK's autumn budget 2025 stirred debate over tax thresholds, dividends, and investment uncertainty, she was among the voices called on to make sense of it. Today, she also mentors the next generation of scholars, guiding PhD researchers who are exploring how venture capital, taxation, and banking practices shape innovation around the world. Today, she joins us to walk through one of her most compelling papers in her own words. Does financial innovation lead to technology innovation? Evidence from foreign exchange derivatives. Let's welcome her to the conversation. Professor Sapnoti, it's a pleasure to have you with us today. The honor is entirely ours.
Mr. Deepak Bhatt, thank you for having me. It is really wonderful to be on Business Talk, and it's really nice to get the opportunity to talk about this paper. So thank you.
Thank you. Professor, your paper argues that financial innovation specifically affects derivatives actually drives technological innovation. What originally sparked this collaboration with Dr. Laura Dimitrova? What made you both want to test the link between financial innovation and technological innovation, two concepts that are typically studied in such separate worlds?
That's right, Deepak. These two ideas have been studied separately, extensively for a long time. And Dr. Dimitrova and I have been working for a while in the area of innovation, mostly technological innovation. But we are finance professors, so this question came naturally to us, although, like you say, it may not be a question that is naturally studied by scholars in one field. But I think the audience may not need much of uh, any kind of guidance to understand that innovation is really important today. In today's world, we don't need much convincing. Right? The largest firms in both US as well as Asian markets tend to be ones which are innovating extensively. But whether it's finance that's driving the innovation, or whether it is that their ability to innovate that drives their ability to draw more finance, I think this is something that we wanted to tease out. So just to give a few examples, I'm going to talk a little bit about the rate of innovation in the world. Okay, so let's look at the top 10 market cap, which is market capitalization. That means the total equity, the value of the total equity of these companies on listed stock markets. Now, if we look at the top 10 in the United States in today's date, only one of those top 10 existed in 2000, in the year 2000, which means in the last 20, 25 years, 9 of the top 10 have stopped to exist or been bought out by other companies, or totally changed shape. So we can't deny that the rate of innovation in these companies is tremendous over the last few decades. And if we also look at the rate at which our lives have been changing over the last few decades, um, we can also not deny that the fact that our lives have changed because of the technologies that have come in. So mobile phones are just one example. 20, 25 years back, you could not have probably imagined that every person would have, on an average, 1.5 mobile phones. They were not existent. Only the ones who used to work or the ones who needed something for their businesses were the ones who were probably fortunate enough to have a mobile phone. So innovation is critical in today's world. And so we looked at this through the eyes of finance. Just one more example. One equation that created an industry, and that is very true to very close to our hearts, is the Black-Scholes equation, right? The Black-Scholes partial differential equation was solved by two finance professors, and this led to the creation of a $1 trillion derivatives market. Because we could then price these products, which we earlier were not able to price. So the securitized debt, exchange traded derivatives, credit default swaps, all of these now amount to a market size of in excess of $100 trillion. So the fact that financial innovation has affected innovation in other markets was something that rang true to us, and we chose to jump into this idea and test it rigorously.
Professor, you use the 1987 ISDA Master Agreement as a natural experiment. Can you explain in simple terms why that event was the perfect real-world shock to study this relationship?
Right, now that's another great question. Like I said a minute back, we want to understand whether financial innovation affects technological innovation. One might argue the other way around. Well, look, it may be that patents are driving financial innovation because if we think about it that way, firms which tend to patent a lot, they tend to have more financial resources. Either they have the capacity to raise more debt or they have more cash on their balance sheet, right? So they're very well resourced companies. And one may say that it's the patenting that's driving the financial innovation by these companies, not the other way around. So I'm going to move to calling financial innovation hedging or use of derivatives because that's basically what we test. So this issue is called reverse causality in economics. When you don't know which direction the causal phenomenon is working in. And that's where this ISDA market agreement comes in. So the International Swaps and Derivatives Association started as an informal association of the largest banks, which were creators of swaps and other derivatives. Now, these derivatives tended to be small in volume and value because they were exchange traded, so very standardized. Now, when people were trading corn or they were trading orange juice in the earlier days, they wanted very specialized contracts. They wanted it delivered to their particular port, their particular quality. Now, this was not available back in the 1980s. So what ISDA did was they wanted to standardize all the non-financial terms to make it easy for people, reduce the cost, the legal cost of getting into these contracts. And that's precisely what happened in 1987. So it was a shock that affected derivatives, but did not directly affect patenting. Now, when something like this happens, economists become very happy because this is a perfect way to claim causality. Then when this happens, we can say, look, the shock was to hedging or use of derivatives. Now we can say that, well, the use of derivatives, did it cause more patenting? And that's what we're trying to get at. So it was a very nice real world shock that we chose to use.
Professor, the results show firms with high pre-1987 currency exposure filed roughly 12% more patents after adopting FX derivatives. What does that number mean in practical terms for a company's innovation pipeline?
So let's dive into how we figured that out. So basically, the little bit of the result again, the machinery behind the paper. We looked at the ISDA Master Agreement as a shock, and we look at what the firms who had high foreign exchange exposures before compared to low foreign exchange exposures before the shock. The argument is that before the 1987 Master Agreement, these firms couldn't have traded derivatives. Even if they did, they were of much smaller volumes. So now, if the ones who were exposed to foreign exchange fluctuations before now start using more derivatives, are they patenting more? And we find that yes, they are. The number you gave is precisely correct. What we find in our paper that those who had higher exposures, they end up patenting 12% more in the years after 1987. Now, what does that really mean? Well, in quantitative terms, it means exactly what we find, that higher exposure firms or firms exposed more to foreign exchange fluctuations through their revenues or their profits before the shock, which is 1987, after the formation of this ISDA Master Agreement, are probably going to patent to the extent of 12% more. So they get, for every one patent, they will have 1.12 more patents in future years. Now we find that this doesn't happen immediately. It happens, the actual increase happens 3 years after. And that's also quite a relief for us because it shows you that this is not a statistical quirk. It's something that happens because we just have by chance, which sometimes happens in statistics. And that's because it takes about 2.5 to 3 years for investment in at one end to actually turn up as patents on the other end. So this 12% is an increase for firms who were exposed before compared to less exposed firms. These firms chose to use more foreign exchange derivatives, and they reduced the fluctuations in their profitability. And through this, they were able to invest more, and then they were able to patent more. This is like the crux that we find in our paper.
This research revisits data from decades ago, yet you argue the findings are still relevant to CFOs today. How do you see this playing out in modern industries, say technology or pharma, with volatile currency exposure?
Right. So in today's world specifically, again, we really don't need convincing that a foreign exchange can be volatile. We've seen some extreme fluctuations in foreign exchange soon after the Iran war. With the onset of the Ukraine war, again, there were fluctuations in foreign exchange markets. So these fluctuations are not only unprecedented, but they are also unexpected. So many companies have taken to derivatives aggressively as a defensive device. So what we claim is that that is a half of the story. That's not the full story. And that kind of understanding is incomplete. What we urge CFOs to do is think of hedging as a way to protect future innovation. This is not only a defensive device, but this is the way in which you can protect the kind of company you're going to become later. And there, I have some evidence on not precisely the 1987 shock, but much more recently, where Apple's CFO in the early 2020s, they said that they had increased their hedge ratio to go from 48% to 80%. This is from public news. And one of the reasons they cited was they were trying to protect their innovation pipeline going forward. The same was for Adobe, which has aggressively increased their hedge ratios to about 45%, 44.8%. Merck is one of the largest pharma companies that goes very heavy on currency options, and they've also talked about how this can help them in maintaining their very large R&D pipeline. So with IFRS 9 and other accounting requirements that have come up, these hedging instruments need to be accounted for on balance sheets. And nowadays, we see a lot more firms actually recording them on their balance sheets, which earlier was not available to us. So the fact that we use a shock that was in the late 1980s doesn't mean that our result is not applicable today. In fact, it is more applicable now. The magnitudes may be different now, but the economics remains the same. It is possible to use hedging not as a defensive strategy, but as an active play to protect a company's R&D pipeline and create the innovation that they want in the future.
Professor, if you had to give one takeaway to a corporate treasurer or CFO listening today, what would you say about the strategic value of hedging beyond just protecting the balance sheet?
Right. This, I think, is critical because this is something that is not spoken about enough. Like I said, hedging and using financial derivatives is seen as defensive, right? So the reframing that we'd like to do for finance leaders is quite straightforward. Derivatives are not simply a tool for keeping your earnings line well behaved. That understanding is incomplete. When we are able to use these derivatives deliberately, they can be a means to protect the innovation pipeline, a way to reassure your best researchers and your best research teams that if there's a swing in any market, especially currency markets, they're not going to take away their funding. So the CFO is not going to take away the funding from the research teams. This is a question that the board should not ask, not only how much volatility does the hedging program remove, but the board should also be asking how much of our long-term future investments are being protected. Or said in another way, how much stability is this creating for our future R&D pipeline? So a hedging policy is not a defensive posture at all. It is part of how a company decides where its future lies. If I can give an example, another example, slightly different though. So venture capital companies, which by themselves are a financial innovation, they tend to invest in small portfolio companies, which are increasingly facing currency fluctuations, especially if they produce their product or their service in one country and tend to sell in another country, let's say in the US or in Europe. Now, for them, hedging is particularly costly because they may be negative in their profitability, and they may also be drawing down cash every time that they buy a hedging product because there are margin calls or there are premium payments. But our paper says that these are exactly the kind of firms which should be thinking about hedging as not as a cost, but as a way to protect their future innovation. Because these small companies that the VCs invest in, the VC portfolio companies, they create the next level of innovation, or they create the next product or process, which is going to probably change their industry or have effects much more than their industry. And their patenting is going to be essential for their success, because if they go from 0 to 1 patent, that gives them a lifeline to move forward. So not only for large companies and their CFOs and boards, but also for very small companies, I think our paper is relevant, and it's important that it be understood and maybe applied.
Professor, you tested three possible explanations: financial constraints, information asymmetry, and risk taking for why hedging boosts innovation. Which one turned out to matter most and why?
Right. So these three are, again, something that's established by the finance literature, but I'll try and give a little bit of an applied explanation as to why this is important. So financial constraints, I'll start with that because I already spoke about that. Economists and financial economists think that there are probably two kinds of constraints that companies face. And we've documented this so I can speak to this quite confidently. There are debt-related constraints and there are equity-related constraints. Well, a firm can probably be constrained in both ways, but there are differences in this. So what are debt constraints? Where a company may be very large, right? But because it has so much debt, the debt to market, the debt to value ratio of the company is really high. So under those conditions, it's not that there is a lot of information asymmetry in markets. Everyone knows this is a huge company with thousands of employees, but why can't they raise debt? Well, because they're already so levered, any additional debt will be junk bonds, right? Something that has very high yield, and these companies don't want to pay that high yield on debt. They want to pay lesser. So the supply demand requirements from the market and of these companies is such that they tend to be debt constraints. Let's take a very different example. Let's look at that. So I'll go back to my VC example. A venture capital company investing in a small startup. These companies, let's say they are medium sized, not very small. They have raised some capital, which tends to be entirely equity. They are probably able to raise debt also from the venture capital, but these companies tend to be equity constrained. Why? Because there is hardly any information about these companies, right? They may be founder owned, they may have 10 employees, their success is unsure, the industry is unsure. For instance, all companies that are using any AI model and building upon it have a very unsure future in today's market because we don't know which of these AI models is going to be successful. Maybe all of them, maybe one, maybe none. Right. So all of the companies that are using AI models as an input and creating something on top of that, they face quite a lot of information asymmetry in today's markets. Now, these companies tend to be equity constrained because the equity comes to them at a very high price, so high that it can actually disincentivize from them from investing further. So there are these two kinds of constraints, right? So we test in our paper what kind of companies does our result work for mostly? And we find that this is more true for equity constrained companies than debt constrained ones. So companies which are small to medium sized, those for which patents matter more, those which have fewer patents, not thousands and thousands, right? So for the Mercks and the Apples, this is less true, our result. And it's more true for companies for whom raising that little bit of money for maintaining the R&D pipeline is going to be crucial. So that's financial constraints. And we find, yes, financial constraints are a channel. Then we look at information asymmetry. And here we actually come across a puzzle because I just told you equity constraints, firms are information asymmetry, right? But the problem is the level of information asymmetry and the way in which we measure information asymmetry is quite noisy. Our proxies are imprecise. So we don't find that information asymmetry drives our result extensively. So we can't say for sure that the firms who have a lot of information asymmetry, that is the shareholders understand very little about the firm, that drives our result. No, that's not the case, right? So there's a bit of a tussle here, right? This is a puzzle that we haven't fully solved, but we document that we think this is puzzling. The last thing is risk. Now, if a firms use derivatives, we think that they may be hedging, but they might very well be speculating, right? They could be taking on these instruments and then investing in very risky projects or speculating with these instruments, right? So we test this explicitly and see that, well, this is not what's happening. What is actually true is that the firms which take on derivatives after 1987, they do not invest in highly risky patents. They invest in what are called incremental patents. So patents which don't change the world, but which are small additions to probably their existing patents and keep the revenue stream flowing. So small changes and small improvements. So the firms do not become more risk-taking. So to summarize, financial constraints is a channel which we tested, and it is true that financial constraints drive our results. So firms which are more equity constrained tend to patent more after using derivatives. Information asymmetry drives it less. That means that firms with a high information asymmetry are equally likely to patent after 1987 compared with low information asymmetry. And we test risk taking, which means do firms invest in high risky patenting projects or low risk? And we find the opposite. We find that firms which are taking on derivatives invest in low risk or incremental patenting projects.
Professor, interestingly, you found firms didn't become more likely to pursue radical breakthroughs patents after hedging. Instead, they lean into incremental innovation. Why does incremental innovation still matter economically?
So incremental innovation, again, the way economists have defined it, is a patent that will not change the industry or won't change the world, right? It builds on existing patents and has a small, effectively incremental effect. Why is this important? Well, first of all, these incremental innovations are the engine of long-term growth. They are a quiet engine of long-term growth. And why is that? Because most established businesses, these are precisely the patents from where returns are actually coming, right? So small successive improvements in pharmacological products create a steady stream of revenue for pharmaceutical companies. So if we take an example again, let's look at the Apple phone, right? When the phone first came out, that can be seen as a high risk taking project, right? Something that changes the world. Now, the iPhone, for those users, you know it, and most phones have it, the edges of the iPhone are beveled, right? So they have a particular shape. That didn't change the world, right? It was an incremental improvement to an existing product. However, this beveled edge was seen as a design change, and there were many improvements. There were many less breakages and so on. And these kind of improvements keep adding to a company's revenues and profitability. So these incremental innovations, they're processed and they protect margins one year after the other, right? So if a company has created a breakthrough innovation, it's these incremental innovations that keep compounding the gains from the breakthrough one. So in our paper, we find that it's not the patents which are breakthrough that happen more, but firms which hedge more, they they tend to invest in projects that are incremental, right? So there are steady improvements in products and processes rather than these radical departures which can change the world.
Professor, you found that equity constrained firms benefited far more from FX derivatives than debt constrained firms. What does that tell us about how different types of financial pressure shape a company's ability to innovate?
Right. I spoke a little bit about what it means to be equity and debt constrained. And you're right that we absolutely found that equity constrained firms were the ones that benefited most from this. Right? Most from what I mean this is that when there's hedging products available, foreign exchange derivatives available, it's the equity constrained firms that took on these and then patented more. Right? So these are basically the firms that find it difficult to raise equity. Small to medium-sized firms come to mind. So a company whose value, let's say, lies largely in intangible research, so they have very few physical assets. These are the ones where a lender can find it hard to assess where the value is coming from, right? It's likely that this firm is unable to give collateral to a lender, which is essential for most debt contracts. So these firms face equity rationing or an inability to raise the amount of equity that they need to raise. So for a firm like this, a poor quarter or 1 quarter of less than expected earnings could lead to discontinuing a critical project and shelving it. So for these companies, stabilizing cash flows gives them room to keep growing. And for these companies, these are exactly the ones that may be research intensive and constrained, and most of their equity, most of their cash flow goes into paying for their human capital, which creates these patents. So what we did in the paper was invert a common assumption. So hedging is often associated with these large, sophisticated companies who run a massive hedging program. But our findings suggest that it's not these firms that have the most to gain in terms of innovation, financial innovation. So foreign exchange derivatives that we document are used after 1987. They're more frequently used by these smaller, harder to finance firms for which a stable cash flow is not just a convenience, but it's a precondition for investing.
Professor, what is the closest modern example of the mechanism which you identified?
Right. So I think, given everything that I've said, I think the best example I can give is again of a medium-sized company. I work in the area of venture capital and private capital a lot, so I'll give you an example from there. Of course, this is hypothetical, but I have heard from venture capital investors and some portfolio companies that the need to hedge foreign exchange has become incrementally more in the last few years, and it has taken importance which is front and center for these companies. So imagine a small portfolio company that has its cost base. So all its employees, all its production, and all its facilities are in a country, let's say in India or Israel or in China, one of these companies, one of these countries, and they are selling to either US or Europe. So their final product or process or service is mostly being sold there. Now, these companies may find it hard to do a full hedging program, right? Because hedging also has its costs. It requires either margin calls if we are hedging with foreign exchange derivatives that we document, or if we are doing any kind of options-based contracts that requires payment of a premium. Now, because exactly when the cash flow is going to come in is also unpredictable, it's very hard for these companies to actually hedge. Now, for these companies, these are precisely the companies for which we document that hedging is not only a cost, but it's a way to protect your future profitability and your future ability to stay in business. I think that's the best example I can give of a case where our results, although we tested it in using data in the late 1980s and 1990s, our results would directly apply to a firm in today's day and age.
Professor, I would like to conclude this episode with one last question. Which types of firms today your findings be most applicable for?
That's exactly what I was talking about, Deepak. So it is two kinds of firms, to summarize. Firms which are large and which look at hedging as a defensive method. We believe that this thinking is limiting, is not complete. Hedging using any kinds of derivative products is not just to protect the bottom line, but it is also important to protect future investment projects which lead to patenting. So that would be one group of companies. The other group of companies would be medium, small-sized companies which are equity constrained. For these companies, hedging can seem expensive, and they may not even think about hedging because it draws down further on their profitability if they're already in negative profit territory. But for these companies, we think it is business critical to invest in hedging because 1 quarter of negative earnings can take away funding from exactly the project which would have given them the future lifeline and which would have made them successful. So these two are the two big sectors, not sectors, yeah, the kind of examples that I think our paper applies to today.
Professor Sapnoti Eswar, thank you for taking us behind the numbers of your research. and showing how something as technical as a 1987 derivatives agreement can reshape the way companies innovate decades later. Your work is a great reminder that financial tools aren't just about managing risk. They can quietly unlock a firm's capacity to build and invent. Thank you so much for joining us today, and it has been a truly privilege to having you on Business Talk. Thank you once again.
Thank you, Deepak, for having me. It's been a privilege. Thank you.